All right, welcome back once again, Griffin, joining us in the co-host seat. Welcome to 2026. Happy New Year. How's it going, Griffin?
Happy New Year. Happy New Year to all the listeners and those that are watching. It's been a great 6 days of 2026. We're filming on the 6th of January, and so it's been an eventful 6 days, but seems like an eventful start to what is hopefully an eventful year here in Great Capital. All positive things.
All positive things. Griffin, I'm curious, before we get into multifamily, before we get into these articles, some of the reports, is there anything that you do, your family, you and Kristen do, kind of the beginning of the year, kind of goal setting, just, whether there's nothing special about, December 31st to January 1st. You can set goals, you could get your house in order at any time during the year. But for so many, it's a great opportunity to, take account of what happened for the last year, make plans for the future,
Right.
put it all in perspective. I'm just curious. And I didn't tell Griffin I was going to ask about this at all. So I'm putting him on complete spot, which is the best.
Yeah.
What do you do? What are your thoughts?
My wife is very introspective.
Yeah.
She thrives in moments like this where you get to take a step back, look in the rearview mirror, and see what we did well or what we didn't do well in 25, whether it's for her personally, professionally, or for us as a family, as a sister or a brother, whatever it might be, whatever aspects, categories in your life that you have. She loves to look back and then, based on that past year, what can we do differently, or what can we build for ourselves or work towards in the coming year? And so she always, on New Year's Eve, will sit down with a piece of paper and run us as a couple, and then each of us individually through an exercise of, essentially, what did we excel in 25? What did we fail in 25? What did we learn from both those experiences? And how do you want to take that and move forward into the next 365 days? It has been a new thing in my life since we've been dating and then now we're married. So it's I try to take it rather seriously because I know it matters to her, and it's very important to her that I take it on myself personally to try and grow, not only with her but alongside her. And so we absolutely do that. One of the things that we've prioritized really tried to do it in 25, but I'm not sure we did a great job of it. We seem to give a lot of our time and energy to other people. We don't give it back to ourselves or reinvest it into our relationship. So in 26, we're just trying to be a little bit more proactive, less reactive, own our own schedule in regards to maybe it's work, maybe it's social scene, maybe it's traveling and family and friends. But more importantly, in what will be our first full year of marriage, giving our time back to us to then kind of work towards developing a long-lasting, healthy relationship with the potential of some kids in the future.
I was going to say, take all that time for yourselves now before you have kids, because when you have kids, you're like, what time for ourselves? What?
Now, as an individual, and I haven't mentioned this in the office just yet, but each year, once a year, I try to see what I've got in regards to the mustache growing. And
I've been noticing. I haven't asked you yet, but I see something.
Primarily in the first 2 weeks, 3 weeks of the year. At some point in time, it's going to stick around, but I have yet to really get to a point where I feel comfortable with the way I look. I still don't have it. It's not there yet. I'm in my 34th year of life here, 33rd year of life. Can't grow a mustache, but I'm not going to let it deter me. So there's a couple more days, maybe weeks. I'm going on a fishing trip here with my
there you go.
Dad and 2 brothers, and everybody will show up with a mustache, and mine inevitably is always the worst. So something I do every year is trying to see how I look with a mustache.
Well, the disadvantage that you have is that you're usually very clean shaven. Unlike me, I'm often usually donning a beard, and so when I want to go mustache, it's just addition through subtraction. I shave the rest of the beard off. I can don the mustache for a couple of days, then I can just delete it and go back blank slate. But for you got to grow the stash from the ground floor, which you have to go through that awkward transition period of kind of the stubble, and it's a rough go. But the genetics haven't passed through to you because you're getting together with family. So you missed out on the. I think you would look good with a stash.
If it was a good stash,
I think it would be.
The problem is
it's
fitting.
Not. How long do you give yourself?
So I've got about 3 weeks this year, and it's not enough time. I my stepdad, who I'm going on a fishing trip with, he left town and he went down to Florida. He's going to be down there until we go fishing.
Is he down there now?
Yeah, he's got an incredible mustache. And so I was like, shoot, he's got a nice head start. I got to get going. it'll come off immediately after that trip, if not in the midst of that trip. I just can't show up
without at least making an attempt.
with the scalp lip.
Have you considered any serums or anything really to help you along?
Yeah, this
give
is all
kickstart?
natural. There's nothing wrong with using some performance enhancing
Yeah,
products. However, I will say that this has been an annual thing, and my wife, Kristen, she's on board with it. She would prefer me to grow out the full beard, but that's even more embarrassing.
She would prefer you to go with full beard?
Yes,
okay.
yeah. She likes the beard or the stubble. For
Yeah.
me, it's a more of a respect thing passed down from my grandfather to be clean shaven, present yourself in that clean fashion. So, it's a potential as we just lost him this year that maybe I show up with a little bit of disrespect on my face and try to grow a full beard or a mustache. But for the Gray Report, this is good news. If you're a listener, you just turned into a viewer. Because I know you want to see.
Well, and we'll have to post the link down in the comments. But I don a mustache for a good month and a half, 2 months.
Yep.
I think
you did
2024.
See,
you have to go back to the archives.
You've got the talent. You've got the capability to do it. And for somebody that's a little lackluster on the talent and the capability, it's tough to walk in the door into a room full of serious people. But I do it anyways, just to see what I got. And it's obviously 2026 is. Maybe not my year, but looking forward to 27.
Yeah.
The mustache in 27.
Well, outside of mustaches, it's going to be an interesting year, not just for facial hair, but for multifamily.
Right.
We've talked about, we're in this kind of this air pocket of supply. Supply's really dropped down, especially not in every market. And again, there's a Sunbelt versus everywhere else kind of conversation. Like in the Midwest where we're seeing supply come down, like Indianapolis. I mean, it's a fraction of where it was last year, which is a lot of relief because your rent growth has slowed down. Vacancy is pretty high right now. There's other issues that are going on, which I haven't seen talked about that much, but collections are becoming much more of a challenge. The consumer is being squeezed. So not everything is rosy right now in the multifamily market. Even we've said it's kind of the darkest before the dawn, perhaps. But there is some relief coming from less supply coming online. Any other themes? We put out this research report, the Midwest Multifamily Forecast, which you can download. Go to the Great Capital website. There's a button right there to download it. Any of the other themes that since we put out the forecast, whether it's loan maturities, whether it's supply, any other themes that have really kind of come to mind that are sticking around, or anything that you've kind of maybe changed your mind on? We were talking at the end of last year, and any new information that said, I kind of was prioritizing, this thought, but now I'm really focused on I think data centers are all going to burn up and go to zero, or
right.
What any hot takes or developments kind of since we put out the Midwest Multifamily Forecast.
Right. I think just as a part of the research involved in putting that forecast together, and then kind of the matriculation of the report to its readers, we did the webinar, and then I'm putting the newsletter together. The thing that I think I've seen that's maybe a little bit kind of against my expectations is the amount of capital that seems to be kind of pouring back into CRE currently.
Yeah.
Or maybe is posturing to pour back into CRE.
Yeah, that's a good way to put it.
The past year in all of our equity raises, and just talking to folks that are fundraising and raising capital, it seems to be that there are some headwinds involved, and just the high level of uncertainty that has kept people on the sidelines or kept people's powder dry, while there's still I would say a significant level of uncertainty as we move into 26. It just becomes interesting as I've seen a lot of these, reports, surveys, data points that indicate that institutions and family offices, RIAs, different allocators are looking to put their dry powder into commercial real estate assets, not just multifamily, but you mentioned data centers. I've seen a kind of a resurgence in the appetite for retail. As some of the returns relative to the risk have become more palatable. There's a lot of people that are now kind of back and interested in the office sector, as people kind of return back to the office. The prices, the asset values on offices have become, I think, of interest and great entry point. And so there's just this, I would say, a buildup of momentum in regards to capital allocations into CRE that otherwise I was not expecting as we ended last year.
And it seems like a lot of this interest is first being led by the family offices, which is, I think, a little,
Sure.
and some institutions, obviously, like Blackstone and KKR. They made some big moves last year, kind of kicking things off. And I think that was a kind of an all clear sign that wasn't fully absorbed by the entire market, because it seems like it was the very top end of institutions, the largest institutions that gave that all clear. All of the institutions that seem to be kind of, and I use the term institution kind of broadly, but really, sophisticated institutional private equity it's allocating to real estate, they all kind of seem to stay on the sidelines or still preferring kind of the private credit space, a little bit more, safer, using air quotes, position in the capital stack, where the common equity was really dried up. But the family offices, in this last year especially, we saw really re-enter the market in a very strong way, where some of that institutional capital is, I think what you put it the right way, really positioning themselves or posturing themselves to make larger allocations. There have been some surveys that have come out recently that have indicated that most groups are planning on to increase their allocation to CRE next year, and assuming then the subsequent years, so everyone's ready to get back into it. I wonder how much liquidity events need to take place, because there's also, while everyone wants to go and buy real estate, there's all of this real estate that was bought previously in older vintages, whether that was the last couple of years or even 5-7 years ago, where folks they're waiting for the opportunity to cycle out of those deals to then go to do new deals. I mean, we have some assets in our portfolio that we don't need to sell because we don't have a maturity coming up, but they're assets that that we've either we have a ton of equity in, and it'd be a great opportunity to go full cycle on some, but we don't want to sell at the wrong time when in a year from now we feel like there may be a better environment to sell. Cap rates may be slightly compressed, or maybe we're going to get a little bit more rent growth, or maybe a prepayment penalty is going to be burned off, or there's some other assets of where we've said, hey, this is going all right, but we want to prune the portfolio. This asset is taking a disproportionate amount of our time to manage, and we think that there could be better opportunities elsewhere, but we don't want to sell it now when, again, in a year we think there's going to be a better opportunity. So we're seeing a lot of people saying one thing and then doing the other.
Yeah.
Same thing with consumer sentiment. It's almost the opposite, actually. Everyone's saying that they're really worried about the economy and that we're going to go into a recession and everything is horrible and AI is bringing into the end of the world. Yeah. But we're spending a lot of money still, and the economy is still chugging along. It's almost like the inverse of that. But it's fascinating. What concerns you about 2026? We've talked about what the kind of getting through this muddy middle into the promised land. What really worries you? That whether it's multifamily related or even macroeconomy.
Yeah, I think it's in both. Is this the ever increasing rise of expenses kind of across the board? I've noticed in my personal life. I've noticed it here in our portfolio. How much expense growth can we currently handle with some of the supply pressure and some slower accelerating or flat rent growth? Is a little bit concerning to me. I'm watching some family members of mine. I'm watching friends of mine having kids, trying to figure out where they can put their income in order to fund their life. And I started thinking about some of the tenants at our properties, and like you mentioned, delinquencies are ticking up, and is that due to other objects or other services and goods in their life becoming more and more expensive? How is that going to impact the overall multifamily industry? We've seen I would say some slower rent growth here in the Midwest. We've seen negative rent growth across the nation, but we've also seen rising expenses in regards to the goods and services, as well as just overall insurance. It's just a math equation that if it persists, it doesn't end up with a very positive story for our business and for our investors. And so that would be maybe my main concern, is this ever increasing. I don't know if it's the inflation that we're reading about kind of constantly, but we saw in the last CPI it actually kind of drew back. And so I just don't understand maybe necessarily why a Chipotle bowl is costing me $20 these days, and maybe it's $17. But in high school it was.
You've got the red chimichurri and the guac.
Well, that's true. I'm getting the extra stuff, but it seems like things are a little bit expensive these days.
No,
it's concerning me personally, but also in our business world, it's also creating concerns.
It is. Well, and again, it's our portfolio. It's most portfolios of where just the OpEx has just ballooned and has broken a lot of budgets. The question is, how much of that will it continue? How much it is. Are we going to see continued high year-over-year growth rates, or have we seen the bulk of that growth and inflation is in the rear-view mirror, and we're just kind of dealing with it, and now we have to have the revenue kind of catch up a little bit, which is a little bit delayed?
It was interesting. This is again kind of a personal anecdotal story, but we had some family in town from LA for the Christmas holiday, and we took them out to dinner. We had party at 10, we had party at 4. We were just entertaining, and you could kind of see the look on their face of like, what this dinner for people only amounted to this dollar amount, where in LA, they might go out to dinner for 2 and it's that same amount. And so they were just, and they're from here, born and raised in Indiana. It's just like they just kind of forgot the relative affordability of living in the Midwest relative to Los Angeles specifically. But it's a nice reminder that while I think things are ever growing in expense, that there are people that live in markets where the affordability is much more drastic. Yeah, correct.
Jay, our chief investment officer, made a comment to me today, and it was on the same topic of reducing expenses, and everyone's kind of tightening the belt a little bit because you kind of have to to make it all work. Jay said, "You notice we didn't get nearly as many gifts to the office, like kind of corporate gifts, end of the year, little fruit basket, candies, cookies. And I don't think it's because people don't like us anymore. But in previous years, it would just, the whole table up at the in the main area of the office would be filled up with with gifts and stuff.
If you didn't send us a gift this year, it's not too late. We're still receiving.
We're always receiving. But this year it was light. And I hadn't really thought about that. And again, we still got stuff, and it was awesome. Thank you, everybody. And you don't need to send us anything.
No.
But again, it was just another anecdote of, and we even changed our strategy because we were looking at what we were going to send. In previous years, we've sent really big, or not big, but we've sent these gifts to our investors, and we were looking at what that was going to cost us. Another $25,000. And we were like, well, I don't know if is that the best use of our money right now? Do we spend $25K on sending? And in this case, we were like, because we have more investors. Every deal we do, we add more investors, which is awesome.
Yeah.
And we were going to get everybody, like a local cookie, thing.
Yeah, it was going to be a nice idea.
We were like, these are good cookies. This will be nice. On a per investor basis, it seemed reasonable. But then times all of our investors, it was like $25,000.
Yeah.
For 6 cookies. I'm like, $25,000 for 6 cookies.
It was a little steep, and it also just the math was not making much sense in these times.
And we figured if we weren't going to send something really kind of substantial.
Yeah.
It's more of the thought that counts. Hey, we're thinking of you. We want to wish you, happy holidays, Merry Christmas, Happy New Year. So we decided to send a card.
Right.
I still think that was the right decision. I think that at the end of the day, in an environment where, again, commercial real estate, most companies with great capital, included, a large portion of our revenue is transaction based. So if we're either we make the most of our money when we sell an asset. We do a good job. We manage it well.
Yeah.
But we also the way that we pay a lot of our salaries and keep the lights on is through deal fees. It's not money that we pocket. It goes to it's going to pay everybody's salaries and all the operating costs.
Right.
And we've positioned ourselves with our property management company, everything else we do, to where we're not absolutely reliant on those deal fees. We could go a year without doing a deal, and we'd be fine. And we're almost to a point of where we can do no deals and be fine. But, doing less deals, as the entire industry has done less deals, volumes are way down. We'd like to do, 3 or 4 deals a year. Did 1 deal last year. And the reality is, I'd rather need that money to, bring on the next person I'd rather give, honestly, the team, or people that have been moving the needle for the company, rather, bonus them rather than send investors cookies.
Right.
Right. Not
6 cookies.
And I think our investors would want that also. It's like take care of what's important.
Right.
Save the cookies, and then we're going to invite you in Indy. We'll make you cookies.
Make sure your house is clean before you send me a gift.
Do all that
make sure
stuff.
you can run your show before.
Yeah.
Yeah, I think it makes a lot of sense, especially if stewards of capital, other people's money.
Yeah.
You need to be making decisions, investment decisions, whether it's at our properties or at the corporate entity, that makes the most sense and puts the company in a position to succeed. So, like you said, it's the thought that counts. I don't think we burned any bridges by not sending cookies this year.
Yeah, I think so. I mean, maybe it's cheap, but I think. Again, I don't think
we were talking about rising expenses, and that was a controllable expense that at the end of the day, I think the correct decision was made. So,
yeah.